So the liquidity in that instance is your friend, but I think sometimes it can be your enemy because sometimes the last thing you want to do is be affected by all the noise. Most of it is completely rubbish and irrelevant to the investment appeal of your chosen company or companies, and you should do nothing.
Hello and welcome to the Fundamental Asset Podcast with Fund Manager Chris Boxall. Today we will be covering three recent success stories: Castings, Kooth and Kitwave. Acquisitions, do they really make sense? Covering Marlowe and Gooch Housego, and how Chris creates an internal and external environment for patient investing. Please note that this presentation is for educational purposes only. All opinions and information are for educational purposes and do not constitute investment advice. If you need financial advice, please consult with a regulated financial advisor in your country before making any financial decisions. With that said, let's get started. Hello, Chris. Great to join you again.
Hello, Lee. Hi, good to be here as usual. Always good to have a chat through stocks and the markets.
Shall we start off with some positive news then?
Yeah, I thought one of the businesses I thought it was worth drawing attention to is a small cap. It's on the main market, not AIM. It's called Castings. And as the name suggests, it specializes in casting metals. Most of its market is actually goes into the lorry industry, big casting parts. It invests very heavily in new technology. And I would implore anybody interested in accounts to look at Castings numbers. It's been around a long time. It won't excite some people, but it produces squeaky clean accounts without an adjustment or fairy tale EBITDA in sight. And it also rewards its shareholders with some socking great dividends as well. So every so often, as the cash accumulates in excess of what it needs to invest in its own business, it chucks out a big dividend. Nice clean numbers, nice concise reporting, nice business. So big tick in the box and really refreshing. And if only more would follow its lead, that's what we would ask for.
Yeah, it's a great example. You're not a big fan of EBITDA, are you?
Hate EBITDA. I can't stand it. I can't
Yeah.
stand it because I think maybe when it was first created, whoever created the term had good thinking in mind. But since then, we've had adjusted EBITDA, underlying adjusted EBITDA, and all sorts of weird of wonderful. And it's just an excuse for fudging the numbers, in my opinion, and presenting some inflated sum that everybody wants to read about. I like
Yeah.
clean reporting, and I think Castings is one company that illustrates that.
Yeah, that's a great example. And what do you think about Kooth as well, who's just reported today with some really great news?
Yeah, amazing, really. A little AIM company. It's 100 odd million market capitalization, a bit more than that. I think it listed in 2020. Like many AIM stocks, it's fallen a lot, and it provides digital mental health services and technology to support mental health. And it's announced a huge, it did give an indication that this was on the cards a few months ago, but it's formally announced a huge contract with the state of California.
Yeah.
So the entire state of California, it's got this whacking great 180 odd $1 million contract that for the next few years to provide its services. And it could lead on to other things in the United States. For a small AIM company to secure this kind of deal is quite something, really. Hopefully, the first of many more contracts for it.
I bet there was a few champagne corks popped after the announcement for that,
Yeah,
wasn't there?
absolutely. Look, in a
It,
dire market for small caps,
huge.
you can really see, and those shareholders that have held this stock through thick and thin, or maybe supported at IPO, have suddenly been rewarded. It's not an easy one because it's not yet profitable. But with this sort of deal, clearly all the hard work and all the investment it's put in over the years, it's going to hopefully come good. And hope this,
Yeah.
this could be the start of something a lot bigger.
Yeah. Breaking into the US is notoriously hard as well, isn't it? So
Impossible. How often
you
do
don't
you
hear it
see
that
a
much.
No, a UK company to get this sort of deal is, unheard of, at least in AIM anyway. So yeah, good luck to it. We hope it can deliver. It's raised a bit more money. It needs to raise a bit more money to support it. But rarely, first time in a while, it's raising money at a premium to what the share price was before. Most companies, when they raise money, they have to do it at a discount. This thing, the shares have shot up today on the news, the contract
Yeah.
win. It's a real coup, dare I say.
Yeah, congratulations to Kooth. There's another company as well that you mentioned, Kitwave, who's still a founder-led business, which I'm sure there's a lot of private investors listening to this will like to hear that a founder-led business is doing well.
Yeah, and this is another nice one, and it was refreshing to see clean numbers again. It's a wholesale distributor, so it's got a pretty nifty system and network, and it supplies goods into a huge number of small retailers around the country. And it came on to a year or so ago, and it's just been upgrade after upgrade. this is not the most thrilling company. So again, a good lesson for people looking at businesses. You look at all these jazzy technology stocks or industrial groups that are doing something clever or IT companies of some kind. But this is just really an old-fashioned distributor that's got a terrific presence in the UK, founder-led, sell down a bit on IPO, but remains a really meaningful shareholder and is still running the business. And it's made some acquisitions. You look at the numbers and it's also producing very clean numbers. It's not trying to hide anything. These are quite clean results. And again, it's good to see. And it's just benefited from upgrade after upgrade in a very simple business, albeit one that clearly has to be managed and run really well. I think it supplies into 42,000 separate retailers. Huge job doing that, I would say. I mean, I
Oh,
can't
yeah.
imagine how you could go about it. It's just absolutely fantastic, I think.
Yeah, that's really impressive. 3 companies on AIM that are doing very well. But perhaps maybe at the opposite end of the scale, you mentioned acquisitions there for Kitwave, and they've gone well, and the founder-led business has integrated these acquisitions very commendably. But at the other end of the scale, there's Marlowe, who's been on a bit of an acquisition bonanza, shall we say, recently, and they haven't gone so well. So
I think this is the polar opposite. So you have Kitwave, which was developed from a base by a founder who's still running, and they're making small and gradually slightly bigger acquisitions as you go along, but with clearly somebody that has to have a tight hold on operations, and they're buying clearly businesses that are quite good. Marlowe is arrived on the stock market in 2016, I think it was 2016, and its stated objective is buy and build. So it's got a management team that have done this before at other listed companies and just bought and bought. And we've totted it up and been doing some work about on this business. It's recently announced results with full of adjustments, loads of adjustments. It takes you a while to drill through all the adjustments, but you get to a business that was valued at 500 odd million, generated real free cash flow in the year of only 6 million quid, and the prior year was negative. So this is peanuts for quite a large business. Now it's made 65 acquisitions since 2016. I would say for any small business to execute on 65 acquisitions is pretty demanding. They've come at a cost of nigh on 600 million quid. It's just massive. But not only that, if you read into the detail a bit, you find that they've spent 54 million on top of that in restructuring costs.
wow,
So the
yeah.
implication for us is what they're buying must be a little bit messed up, or they haven't really quite thought through the whole process of integrating these things. We've called it an accident waiting to happen, in our opinion. But management have, as I say, done this before. Another group, which is also now being found wanting, is also struggling a little bit. But I, for the life of me, can't work out how any smallish business from a standing start can keep making acquisitions like that
Yeah.
and have them work so seamlessly. Many of them surely are going to fail.
So, what's your thoughts on acquisitions then? Because we've got one company that's executed them really well, and one company perhaps at this present moment in time hasn't. Now, that may turn around for Marlowe. We don't know at this present moment in time. But what's your thoughts on acquisitions? Because they are quite common in AIM.
I think there are countless little companies on AIM that actually start off as quite good businesses. So, on a business perspective, they tick a lot of boxes. Margins look good, return on equity looks good, cash flow looks good. They all look good. And then they go onto a stock market and they're obliged to get bigger to justify properly. Not surprisingly, the stock market. So they get sucked into making acquisitions, some of which don't work. Clearly, if you do it on the big deal, it isn't going to work. And another business that does really interesting things. Marlowe is a services business and a support service is what it's called. This another business is called Gooch Housego. It does interesting things with photonics and lasers. It's a manufacturing company and it supplies into some interesting sectors. Semiconductor sector in particular is pretty exciting at the moment, and it's supplying into that. But you look back at Marla, Gooch and Housego, we'd love an excuse. We dearly love a good excuse to invest in this business. But all we've seen over the last few years are declining margins. I know we've had a pandemic. It can't have been easy for it at all. But even before that, we've had declining margins, declining returns on equity. The business is twice the size in terms of revenue, but a fraction of the quality that it used to be, which is sad in a way.
Looking at the share price, they actually started in 2009 at a low of 40 and peaked at 1,880 in 2018.
That's interesting. Going back that far, it was on the market. I think when did it list? I think in 1997. I think it was
Yeah.
listed in 97 on AIM. You've clearly had a very good business there when it excite with
From 2009,
actually
from a low of 45, which was the low of after the great financial crisis, but
right.
it's had a 10-year rise up to 1,880, and now it's at the very low 600s, dropping to 450 at its lowest.
It's had a good run. It was clearly delivering on its initial promise. I suspect without all delving back, it just you get sucked into this continuance of acquisitions. You feel you need to start doing them. I don't. There's been a change of management team again, but after a while, then everything needs cleaning out. So you got a new management team in. I think the person's been in there for a few months now. He's already made another small acquisition without having actually fully tidied things up yet. There's a defined plan now. It looks credible, but I would have been inclined to try and deliver before buying something else. Perhaps there was a very good reason they wanted the business they bought. But I think it's in the States they bought somewhere. But I think maybe a business gets sucked in by its own importance, and maybe shareholders as well are driving it as well. They want to get a piece of this company. It's small. In order to do so, it needs to raise more money. And so they're happy to come on board. But sometimes I think just things need to settle down. Businesses need to deliver organically their own self-help rather than just try and sell a good story to the city to raise capital, which anyway at the moment is pretty tough to do.
So what's your thoughts on acquisitions then, and why do they seem to be so common in AIM, and do you think they make sense for companies to go down the acquisition route?
I think smaller companies, the reason for being on the stock market is a vehicle and a mechanism to help support acquisitions. And often they can make sense. I think they're very hard, logically, applying a dose of common sense. In people led businesses, I think they must be pretty hard. You've got to integrate lots of different personalities. There are countless examples of businesses in the media, the design area, where there have clearly been issues and which have struggled to really develop. I think product led businesses, it's probably easier.
Yeah, that makes sense.
They can slot in. So yeah, I think they're good, but I think they need to be well thought out. I don't think it's any accident that Kitwave hasn't been on the market that long, but it's still founder led. I suspect when founders, I think there's evidence, clear evidence, when founders are still running things and have importantly got a lot of their own equity stake involved and their own skin in the game, acquisitions are done more carefully than businesses where you have hired hands involved who have small amount of equity. Notoriously, many years ago, there was a company called Conviviality Retail which flopped on a weird business plan that went so initially one thing and then another, driven by a CEO who was making loads of acquisitions. They were just totally wrong, and she never had any real skin in the game, not until after the horse had bolted anyway. I think the founder-led businesses seem to think things through a little bit more carefully than ones driven by outside management.
After speaking to so many different private investors, and just recently we had Rosemary Banyard on the Fund Your Time podcast, and she stated as well that one of the things that she looks for now is skin in the game, as you've said, that she likes to see that the management or the founder still has a share in the company. I suppose
Yeah,
that's
no, Rosemary's very good. She's been analyzing, assessing companies for a long time. And it's been proven over time that family controlled businesses have outperformed generally those that aren't family controlled. There are countless examples of family controlled business and the outperformance that segment brings, really. And yeah, I think you're seeing it now on the need to cut. Maybe it leads on to another topic we're going to be discussing, but the need to cut and to cut the workforce or make necessary cuts. I think a certain founder-led business has been more aggressive at it than others.
yeah.
And that's notably Facebook, or now called Meta Platforms, where Zuckerberg's still one of the, I think he's the few, I think he was the only founder still running one of the big US technology groups. He was very quick and aggressive to cut their workforce and make the necessary cuts.
It's starting to come through in the numbers, that as well, isn't it?
Absolutely, yeah.
They've now 3x since November 2022, haven't they? So
Yeah, it's been amazing, amazing.
yeah. I mean, I know we talk about little companies here, but still, it's hard to ignore the larger companies as well as Facebook, Apple, etc.
It just shows what a bit of patience can bring. The psychology investing and the need for patience when investing. A case in point of Facebook or Meta Platforms, as it's now called, as I said. I mean, as you said, the stock's gone 3 times over the past year. And when everybody was writing it off, those that sat still and did nothing and look through the hype and all the noise and saw actually inside this business, if you could cut costs back very quickly and it'll get back to what it was before, an unbelievable advertising machine. This is a digital marketing machine still par excellence, which generates huge amounts of cash. It just so happened that they went off on a tangent and were plowing loads of it into
The
the
metaverse, yeah.
that has been cut very quickly.
Yeah.
And suddenly you're starting to see in pretty quick time again, the business of old starting to come through.
Yeah.
And
Going back to its core
the
principles.
investment community, it's suddenly dawning, whoa, wow, it's not all's lost. Look what's happened here. We should
Yeah.
have stuck around. Well, if you'd have stuck there and done nothing, or better still, applied some common sense and when it was really sold off, 3 times your money on a huge company like that in a matter
Yeah.
of months. It's
Yeah.
absolutely staggering.
It's incredible returns, isn't it? And
Yeah.
Elon Musk, when he took over Twitter, don't quote me on this if anyone's listening, but I think he's cut the workforce by 75% since he's took over at
Is he
Twitter.
really?
Yeah.
Wow. Wow, that's
Yeah.
brutal.
Isn't it? So yeah, but it gets back to that. I know he's not the founder of Twitter, but he's definitely of that ilk, isn't he?
He's definitely got skin in the game.
He's got skin in the game with that. Yeah.
At the end of the day, if you need to cut and it's either you or them, you've
Mm.
got to preserve your own position in it. Unfortunately, you have to be ruthless.
Yeah.
When you've got such a big position as he has, clearly he had to do it, had to
Yeah.
move.
So it's an interesting point you raise. Someone who's been doing this for 20 plus years, how do you develop that patience? How do you create the mental state and the environment for you to remain patient with some of these companies that you've been invested in for multi years? Through all the noise, through all the world-ending news that we seem to receive almost on a daily basis.
I think it's an interesting point vis-a-vis small caps and blue chips, tech
Mm.
groups. We've mentioned the benefit of having done nothing or even bought, exhibited patience for meta platforms. In the small cap world where we operate, quite frankly, and the nature of the way of how we're managing money, we're managing a lot of our money for AIM inheritance tax planning purposes, and our investors are obliged to be fully invested. So we have really nowhere to hide.
Yeah.
Should we not like company A and wish to sell out of it, we can't sit in cash and wait for the problem in Ukraine to go away or something. We have to reinvest immediately and be in the market. So we've got nowhere to hide. And that can be a horrible place to be at times when you want to sit out. However, it can often turn out to be the best place to be. You're almost forced to be invested and you're forced to display some patience. Likewise, if you're investing in the world of small caps, and Rosemary and many other managers all say the same, if they're being realistic, it's often hard to get out. If you're managing 5 million quid or 10 million quid, it's quite easy. But when you start getting into the hundreds and of some small cap managers up to 1 billion or whatever, it's impossible to move anyway. Even if you dislike the company, you're stuck with it. Sometimes that can be catastrophic if the business isn't really struggling and you should move. But on other times, it's share price weakness, maybe just a short-term quirk of the market's current dislike and irrational behavior, really. And the best thing to do is do nothing. So being forced to do nothing, the psychology is imposed on us to do nothing, which has proved very beneficial in some occasions. There are exceptions. If we really worried, we're still not big enough that we can't get out. It just takes a little bit longer. It can't be instant. So we got out of a stock this month that we weren't comfortable with, whether we thought the long term was really challenging, and got out of something else. But it took a while and it was a bit more of a struggle, especially in the current market. Conversely, if you're investing in the world of US mega cap or any mega cap, whether you're a small investor or even bigger, even if you hold multi-billion pound positions, you can get out of them. So the liquidity in that instance is your friend. But I think sometimes it can be your enemy, because sometimes the last thing you want to do is be affected by all the noise. Most of it is completely rubbish and irrelevant to the investment appeal of your chosen company or companies, and you should do nothing. But the fact that there is immediate liquidity, that you can sell whatever position you've got almost instantly, makes you trade. You're beloved of the stockbroker and the broking platforms. But maybe at the end of the day, you may be hated by your client. Got out of this company that turns out to be wonderful.
And I guess also as well, that's where your due diligence comes into the actual company that you're invested in. If the story around the company hasn't changed, which is something that Rosemary referenced, if the story's changed, that's when she will then seriously take a look at the company and consider cutting. But if the story hasn't changed, but the overall market is having a wobble.
Yeah, absolutely. And display, I think, a bit of common sense. Another stock, another big end of the scale, Apple, huge company, just touched $3 trillion valuation again. They briefly touched it a few months ago, didn't it? But it's touched it now and gone through it. Only 5 years ago, it was a $1 trillion valuation. It took 38 years to get to 1 and 5 to get to 3. All along that journey, people are writing it off. But every time it's continually released new products that everyone could see were pretty good. The longer term continued to look rosy for that business for some time. So it's not surprising that it's risen in value. I'm not saying that it's likely to double again, but it's not surprising that it's attained such a value. For our world, our primary world, which is small caps, but I think it's a case of patience as always. Businesses are looking, most of the ones, thankfully, on our book are looking quite strong. They've got lots of cash flow. Investors just have to sit there and ride these out, because sooner or later the true value will come out. And if you're picking up a few dividends along the way, that's helpful.
It's interesting what you say there, cash flow. Speaking to many different private investors now on the podcast, that's a common theme that keeps coming through as well with private investors who have done well over the years. Cash on the balance sheet and good cash flow. And again, you've just mentioned it there. Rosemary mentioned it. So that's something else to note. Just to highlight in case the audience has missed that over the different sort of past episodes.
We nearly now almost ignore the income statement and the headline numbers. We only look at the cash flow. On occasions, that doesn't really present the true picture, but most of the time it gives a better assessment of what's been going on. So I would implore people to look at the cash flow and look at the movements, the detail of the cash flow. And that makes actually investing life quite easy. Cash flow, and reconcile it to whatever cash or debts on the balance sheet if you want to look at the financial statements. Common sense, as always, pays.
And patience. Thank you, Chris. Brilliant. Another great episode. Thank you.
Thanks very much.
Well, that's it for today. Thanks for listening. If you enjoy this type of content, then please subscribe and leave us a comment to let us know. We also have many other investor-related podcasts and expert hosts on the Fund Retirement Podcast Network, so please feel free to check them out. If you would like to get in touch with Chris or a member of his team at Fundamental Asset Management, then please visit their website at fundamentalassetmanagement.com. The links are in the show bio just below. Thanks for listening, and I hope you have a great week.